The January jobs report was released last week Thursday morning, and we saw trillions of dollars eliminated from each asset class following after the release. Was this a routine outcome or a sign of stress under the hood? Well, let's talk about it. Welcome back to the channel. Tune in or go stout. In today's time where markets move faster than ever, it's hard to tell what's moving the market and how you should react, and I think this last week was a good example of how to read the market. Before we discuss if the outcome was normal, we need to understand what happened in the first place. Last week Thursday, the Challenger jobs report was released and the market did not like what it saw. Challenger is reporting that US-based employers saw a 108,000 jobs cut, which is a 118% surge from this time last year. But if that's not staggering enough, it's a 205% increase from just last month. If you've kept up with this series on this channel, you know that this is no surprise. If job reports are being released, you can almost assume that it's always going to be a bad jobs report. I hate to put it like that, but since September, we haven't really seen a positive one. And usually the best scenario with these jobs report is that they miss, but they don't miss by that much. But this January report reflects something a little more serious. It's always expected that jobs will cut at the start of the year. That is just a normal trend, but it's never usually to this amount. With a number this large, this signals that a lot of these cuts were planned in 2025 and were effective in January. You'd think this would have softened the blow, but investors took the news pretty hard. And that's what you have to understand about job reports. I know I started covering them and people didn't understand why. It was kind of out of the blue, but job reports are like the canary in the coal mine. They shape narratives or change them on a moment's notice. To me, they're like the earning calls for the US government and how well they're doing their job. And they tell you just how healthy the economy is. So when you're seeing job cuts and layoffs hit all-time highs month after month after month, it signals more trouble under the hood. And while investors may forget about this for a week or two, every new job report that drops puts that volatility right to the front of their mind. And if you know anything about investing, it's a mental game more than it is anything else. And with so much news and new headlines dropping so often, it's hard to keep a level head, but you can use that to your advantage. When you start to understand how the news cycle works, then decoding why things happen becomes way easier to understand. And if you're still trading with fear at this point, I think you don't understand it, and we need to teach you the lesson again.
How many times do we have to teach you this lesson, old man?
I love the young people.
So one of my favorite memes is the nothing ever happens meme, because at the end of the day, nothing ever happens. And how should you respond until something does happen? I'd say by doing nothing. I'm convinced after seeing it for the last couple years that the only way that these swings and volatility hurt you is if you day trade. Because while you see the panic online and you see everybody talking about $1 trillion wiped here, Bitcoin is down, silver and gold are down, I don't think they realize that most investors that are smart are not moving anything. They saw the news, they laughed at it, and they walked away from their screens as you should. And the people getting obliterated from these losses are the people who play with leverage and margins, because they don't expect to be there for the long term. They're waiting for something to shoot up in price so they can leave, make their profit, triple, quadruple it, 10 times it, and run like a chicken with their head cut off once they sell. But in reality, it just doesn't work that way. When the market and the sharks smell greed, they know that's when they can strike. And again, what do we learn from the Epstein files? This is all controlled. It's not a coincidence that in December, before we enter January, they were reporting a 4.4% increase in GDP, 2.6% inflation, and a job market that was starting to settle down, as they said. Just for us at the end of January to realize that that was a lie, and actually it's going back up the direction that it was going the entire time. We've talked about how the BLS and other government numbers are just untrustworthy and consistently get revised down. That's why I like to look at ADP and the Challenger reports, because they're actually more truthful and don't see the heavy revisions that we see from government data. And the signals that those reports have been sending since at least April of last year is that the job market is waiting for something to happen. It's been at a no hire, no fire state for a little bit now, but with the highest amount of layoffs announced back in 2025, I think we're starting to see the fires show up, and it seems like nobody has a good way to put them out. The reason that the job report had more of an impact than the Epstein Epstein files, in my opinion, is because the Epstein files have become a saga of never-ending drama, and while we keep seeing these insane headlines exposing multiple governments and entities within them, nothing ever happens, nobody's getting prosecuted, and we haven't even had court hearings in public about this stuff. So I think in most investors' brains, we understand that this is basically a nothing burger if no one's going to go to jail, if no one's going to get prosecuted, and this is good bread and circus. But when it comes to the job reports, this is not drama. These are problems in the infrastructure. You can drag out a criminal case for 5 to 10 years, but the job market shows signs very fast, and by the time you notice the very significant signs, it's too late to reverse course. It becomes a very pressing issue when you have an economy like ours that is being propped up by healthcare, weight loss pills, $30 slot bowls, and AI data centers. While the tech bros finance the AI development, they expect the consumers in America to finance everything else, and if people don't have jobs, they don't have money to spend, which equals the stock market going down. And as much as we like to think that the stock market can just run without people, we need to be reminded sometimes that, yeah, people do need jobs at this stage of the AI race. You can't just replace everybody's job. I don't know if this makes sense, but in my eyes, for the world that the tech bros want to come true, AI doesn't just have to replace the worker, it has to replace the worker's output and spending power that the worker would have brought into the economy. As it stands, consumer spending is already 2/3 of the US economy, and I'm not sure how much longer that can last. With the average credit card debt in America sitting at above $6,700 and the average person not having enough for a rainy day fund, it seems like everything is running red hot. And it doesn't help that we're signaling to more rate cuts coming in the future. And I know what you might be saying in your head, high debt and high consumer spending would be alleviated with lower interest rates. The spending signals growth and the debt would be easier to repay if the rates were lower. But when you're already on the knife's edge of inflation, you don't want to test the waters, in my opinion. But this opinion is not shared with Trump's nominee for Fed Chair, Kevin Warsh. He thinks that AI can potentially drive down or slow inflation and that rate cuts may be justified in the future. And while he has come out a little bit more hawkish than expected and has talked about tightening the Fed's books, I think he's saying what he's supposed to say to sell the act. To think that the Fed cares about the monetary policy of a country to help it is a pretty funny assumption to make, given the Fed's track record and history. But I think Kevin Warsh was the unexpected pick that's supposed to give the market a little bit more confidence that he wasn't bought out by Trump. But in the long run, I think he's the strategic pick that will end up giving Trump exactly what he wants, which is more rate cuts in the end. And while that will drive growth in the market, it will hurt your dollar and cause more inflation. And the 10% drop that we saw in January will just be a routine thing. The game's called currency manipulation and we're just starting. And with all this being considered, what should you do? First, understand that this is just my opinion and not financial advice. But with this knowledge, knowing that the news is heavily used to manipulate the cycles in the market, I say you do nothing. Losses are not realized until you take your money out of the market, and I don't know why you would take it out when it's down. These are supposed to be long-term investments, not poly market picks, so play accordingly. And if you do choose to do anything in times like this, I think you acquire, you pick up, you start buying more things. You don't get rid of stuff. I mean, me personally, I acquired positions when the market takes a downturn, and it's not random. You know, you should always have a watch list of companies that you're seeing how they do or when a good time to enter is, because as last week shows us, you never know when you're going to have the opportunity to enter, and it might be at a price that you never thought was possible. But with how volatile this market is, opportunities open and close quicker than you can think. So while I don't think you should be reactively selling anything off, I think you should be proactively picking things up. As I said in my very first video of the year, active investors will be rewarded heavily this year. Doesn't mean margin users, but rather people who have been waiting to make new positions but haven't found a good place to enter. 2026 is going to present a lot of entry points for you. You just had to be willing to take them and be prepared for those sudden shocks in the market. Again, job report days, big ones to watch out for. Anytime the Fed has a meeting, huge thing to watch out for. Any type of news happening in the Japanese market is another one to watch out for because it's so closely linked to our market. And as it currently stands, the Epstein files, even though they're exposing a lot about the financial industry, are not really a pressing factor until public hearings happen, which there are rumbles that it might start. But as it stands, it's pretty much a nothing burger that people are trying to sweep under the rug as quick as possible. Don't be manipulated by the news cycle. Understand it, see what they're trying to do, and read them for it. Investing used to be an insider's game, and as retail continues to flood into the gates. The market manipulation that we're seeing will continue to get worse as they play with your fear and irrational senses. So become calm, become stoic, and don't pay attention to the noise, but don't ignore it. Sort through it and see what you can use of value. Something I've done to help me shape this mindset a little bit better is ask evaluative questions. When you see the job report, why is it good or why is it bad? If it's bad, what is the outcome? This will require you to make a judgment by reasoning and evidence, which makes your prediction on what the market's going to do a little bit more tangible. And I think with how often this happens, especially as we saw in 2025, this becomes just a natural progression in how you learn. Some of the stuff you can get from the books and the terms, and the rest comes from the current times that you're in. These markets are continuing to evolve, just like with AI and news. So don't be a caveman with your approach. Understand the news, process the news, but wait before you react. That's just my take on it. Seeing the volatility that happened last week seemed like a good place to learn a few things, and I hope you could have made some takeaways, but don't panic. Don't be a reactor. Don't be a panicking. And what is your 2026 strategy? Let me know down below in the comments. I do read the comments. Are you hands off and you just let your investments ride, or are you actively switching and making new positions? If you haven't, like and subscribe to join the thread. And with that being said, thank you for tuning in. Until next time.